It's going to be selling $1 million worth of stocks, and you're going to see me do it in this video. Now, it's going to basically wipe out about 1/4 of my portfolio, and before I keep clickbaiting you any further, it's not because I think there is going to be a market crash, it's because I'm going to be updating my portfolio. And in the next video, I'm actually going to be showing you what I'm buying. But for now, I want to be showing you what I'm getting out of so you know kind of my perspectives on it, and you understand the different types of accounts, because this $1 million that we're going to be selling right here in this video is from a retirement account. And I want to make sure you understand the different kinds of retirement accounts and my perspectives on if you should be investing in them. So the first thing is let's go ahead and let's sell out of our actual $1 million account. All right, so I'm going to go ahead and sell the first thing here, which is BND. BND is my ETF for bonds. BND is basically this way that you can own tons of different kinds of bonds. You can have bonds that mature at different times. It's kind of like all bundled in one basket, and you get the benefits and the gains of those bonds. And the thing with this, which is really confusing, is like the bond market, it's kind of inverse to your actual holdings because this already owns the bond. If the yield goes up on current bonds, this value actually goes down because why buy these bonds and which are already going to have a certain value if the current bonds bring a higher rate, a higher yield? So, what are we gonna see? Lower yields in the bond market? It's tough. So I'm gonna go ahead and sell this. And overall, I don't want to be in bonds for my retirement account. The perspective of the retirement account is the riskiest, longest-term growth opportunity because I'm not going to touch it for, give you a hint on my age, 30, 35 years, right? So I am not going to be in bonds any longer. So there we go. We sold that. Let's go ahead and sell the next. The next chunk that we're going to be talking about is VXUS. VXUS is pretty cool because VXUS is a way that you can own the entire world except for the US. This is a way where you can have international exposure. The XUS stands for does not include the US, so it's the whole world except for US companies. So I'm a believer in an international diversified portfolio. The US has been crushing it in recent times, but who knows? Maybe China, maybe some emerging markets, maybe Europe somehow. It's beneficial to have some global diversity. Now, also, right now we kind of live in a global world. It's not like Apple is an American-only company, right? So there is that whole discussion, and I think things aren't so dramatic on having such a high level of international now that the top American companies service the world. But there's still some value in currencies. There's still some value that we want to have some international exposure. The last one that we're going to be selling here is BTI. BTI is kind of my go-to. It's my golden goose. I'm going to be buying this again. BTI is the US stock market. So you can own thousands of stocks with BTI, the ETF from Vanguard, which is the total stock market for the US. Okay, it's just the US only, which is why we balanced it out with the XUS. Let's go ahead and sell this now. It's pretty scary to sell this this much in one click, 688,000, because if I sold this in the wrong account, I would have to pay capital gains tax. Now remember, the benefit of these retirement accounts is that you do not have to pay tax on the growth or the interest of that account. So let me go ahead and talk about retirement accounts and if you should consider investing and which ones. The biggest thing with retirement accounts are the IRA, or the 401k. So these are the two big things that you've probably heard of, and they are different. They have different contribution limits. They are structured a little bit differently, and you can still get the Roth version of each if your employer offers it with the 401k aspect. But IRA is basically you doing it on your own. 401k is you're doing it with an employer. Now, there's a benefit of the 401k. There's also some disadvantages as well. The main difference is that the 401k is an employer-based benefit plan. So the employer has to be the one that sets this up. Individuals, on the other hand, you could just go ahead and open an IRA, right? With Schwab, for example. The IRA offers you more investments, so you can basically invest in what you want. 401k allows for higher annual contributions. All right, so if your employer offers a 401k with a company match, meaning they'll match your salary. So for example, some employers promise a 100% match up to 3% of your salary. So let's say you make 50K. Your employer is going to put in 1,500 which is 3%, as long as you also do that, as long as you at least put 1,500 towards your 401k as well. Okay. Once you get that match, though, it probably is a benefit to start moving over to the IRA. So you want to max out the 401k with your company's match if it's available, because that's free money, right? Your employer's putting money towards your retirement, which is amazing. If your employer doesn't offer a company match, I agree with this article, you might want to skip the 401k altogether, right? At least in the beginning until you max out your IRA, because your IRA gives you some more options. You can have an IRA or a Roth IRA. We'll talk about that in a second. But the IRA allows you to have, basically, you can invest in anything. Like you can copy what I'm doing if you want. And you don't have to pay administrative fees that like some of the 401ks charge. So there's some limited investment options with the 401ks. But after you hit the limit on the IRA, then maybe you can think about funding your 401k, right? And then after that, after the tax advantage accounts, that's when you should be investing in taxable accounts. Unfortunately, almost everyone does the opposite, right? They're just YOLOing on trades and they are not maxing out the retirement. You should. I know it's far away, guys. I know you're just some 25 to 35-year-old. I know you because I'm the same. But you got to try to invest in the things that have the least tax and the biggest gains with the compounding effect of the retirement account. So let's break down some of the specifics here. The 401k has a contribution limit of $19,500, and then there's a catch-up thing where basically it's more money for people that are age 50 or older, right? So I'm going to try to get my dad to be like, doing his max, right? Because there's no sense for him, my dad, who's older than 50, to be investing on his own when he's not investing with the 401k and trying to maximize that, or at least do an IRA, right? That way you don't pay taxes on the gains. That's a big difference. Like, let's say, for example, my Tesla here, where we have like 600K in Tesla or so between this account and another account. Let's say 500K in Tesla, right? If I only put in 100K, and now I'm at $500,000, and I want to pull that out, I have to pay capital gains tax on the extra 400K that I made, right? If I sold before a year, I would actually have to pay it at my income tax level, but now I pay it at the capital gains tax level, which is around 20%. So that means out of the 400K, I owe 80K in taxes. So $80,000 is what I would have saved if this was in a retirement account, because I wouldn't have had to pay those taxes because it grows tax-free, right? You still have to pay taxes on the actual income that you put into it or the amount you totally take out, but you're essentially not paying the growth. The traditional IRA or the Roth IRA, they both have the contribution limit, which is $6,000. The Roth IRA, though, you're not paying taxes when you take it out. You're only paying taxes when you put it in. It's after tax money that you put in. That's what the word Roth is essentially saying. There's also a 401k Roth. It's less popular, but it's actually the one I'm doing with my business because I want to do the Roth. Why? Because I pay taxes now and the money that's in there is mine. Also, a Roth at $6,000, I still need to check on this, the contribution limit is $6K, right? So the Roth at $6K is worth more than the traditional at $6K. Because you still have to pay taxes on that with the traditional. The Roth you already pay taxes on, so you're essentially contributing more. I need to check on that for sure because it sounds weird to me, but I think that's how it essentially works. Because the Roth at 7K is worth more than the traditional at 7K. Again, you still have to pay taxes. It's not like there is a trick here. If your tax rate's the same now as it is when you pull out the money, then there's no difference essentially, right? But the Roth allows you to basically put more essentially, you can kind of think of it like that, because, instead of a $6,000 traditional, you're kind of putting in like a $9,000 traditional, and then you paid, $2,000 in taxes, and now you're at $7,000, but it actually grows. So I know that might be a little confusing. Let me check on that a bit. You can do your own research on that. But the Roth allows you to pay taxes now. The benefit of this is also that money is yours, right? If Uncle Sam says, yo, here's the deal. Tax levels in the future are going to be super high because we got to pay for homelessness, climate change. We got to pay for the concentration of wealth and how people are going to be maybe more on welfare. And we got to pay for all these things. And the tax rate is super high. With the Roth, you already paid your taxes. You're done. The other thing of the reason why most people do the traditional is they think, okay, when I retire, I'm not going to be making as much money. And so therefore, my income tax will be lower. My bracket will be lower. The thing with this, though, is that I don't plan on making less money when I retire. Okay? I plan on having investments that are paying me. I plan on having a lot of dividends coming in. I plan on having a lot of maybe rental income from real estate coming in. I plan on having so much in my retirement account that I'm taking out a lot of money. It ends up being a high level of income, right? So for me, I'm going to start moving more towards Roths. Pros and cons. The 401k is great. It's free money if the employer matches it. So go ahead and maximize that. After that, I recommend you maybe go into the traditional IRA or the Roth IRA based on your situation. So there are some other nuances, of course. There's contribution limits. We talked about that. There's some ways that they act a little bit different. But the bottom line is, and I agree with this, fund your 401k first if your company offers a match, then fund an IRA or Roth if your 401k doesn't offer a match, or at the end, if you've maxed out your IRA, begin contributing to your 401k. And then, guys, then you can start YOLOing on Tesla or whatever you want to do in your individual account. But you should try to maximize your retirement account. The thing with the retirement account, too, is it's the longest time horizon. So what I'm going to be doing is I'm going to be going into more growth, more riskier, more high stock percentage for my retirement account, right? It doesn't make sense for me to probably have some gold and probably have some bonds when I'm not going to be touching that for 30 plus years. So if there's a market crash, sure, gold and bonds might do better in the short term, but overall it'll probably still even out to stocks. Not investment advice. Take your education seriously. Don't just do what some YouTuber says, but hey, this is my perspective. Thanks so much for watching. Click like if you like this video. I'm going to be sharing with you what I'm buying in my retirement account in the next video. So go ahead and do that by subscribing and clicking that notification bell so you actually see that video. Thanks for watching. Talk to you soon.